Hello, everybody. My name is Bob Klefsaas. I'm president of All-Star Financial. I want to welcome you to the All-Star Financial Quarterly Review and Preview entitled for the fourth quarter 2016, Borrowing from the Future. Are the U.S. markets borrowing from the future is really our big question. Before we get to that, Bob's Corner, a special thanks to all of you who trust the All-Star Financial team and discipline. We're very thankful for you. We also want to let you know that maybe you might be a little bit thankful for our reduced volatility over the last X number of months. Our current betas right now on our income portfolio, balance, conservative growth, and growth, as you can see, are significantly under our policy statement limits and ranges. So we've taken chips off the table. We think it's not how much you make, it's how much you keep. 8-year bull market run here, it's probably time to take some reduced volatility and risk. Market overview, we want to talk a little bit about, again, what did we mean by borrowing from the future? Domestic stocks riding a huge wave here, obviously, of optimism since the election. We kind of call that the Trump card, the idea of economic growth through reduced tax rates as well as other monetary scenarios that he can bring to the table. And rates, again, kind of in conflict, rising. So we don't want to see rates rise too fast to slow the economy down, yet we don't want to have a significant amount of inflation also. So market overview is going to be, again, kind of a fine line there. International, we have trade talks by Trump, and it's really sent the market reeling. Internationals, as we'll talk about, were up significantly through the end of the third quarter, and in the fourth quarter we saw them reel based on just conversations that Trump was throwing out there. Word of the year, uncertainty, and that's probably something we've used in the last couple of years also, but probably more now than before. With the Trump tax reform, is that going to be something that happens sooner than later? The Trump infrastructure spending, the promises of getting our economy going with more infrastructure spending, where does that take us from a tax liability standpoint? Does the economy grow fast enough to be able to spend that kind of money from a tax revenue standpoint? Fed, again, walking that tightrope monetary policy as far as interest rates. And the dollar is at all-time highs against other currencies. Is that going to continue? And growth opportunities in Europe and the emerging economies. Those are, again, our uncertainties that, there's a lot of them out there. So really what brings to the table, the word that brings to the table for me is diversification. It's going to be the key, again, going forward. The U.S. economy, when we look at defining it as kind of the Trump card, could be the changer. We've had an economic growth scenario for the last 8 consecutive years. The market has gone up, fourth largest streak since 1900. Our annual growth, however, GDP has only been about 2.1%. So pretty paltry. Unemployment stands pretty good at its lowest point in a long time. Corporate earnings and profits have declined. They've been held steady and probably artificially steady by some buybacks. But now we're seeing corporate earnings maybe have some momentum in and of themselves with expense management, some modest revenue growth, but also that potential tax savings could be significant to economic scenario for the U.S. Lower tax rates, we say, meet higher interest rates. That can be a conflict at times. That conflict hopefully is not something that will be significant. But again, what we've promised to see from Trump as far as tax cuts, and then the Fed raising rates could be in conflict from that. Bond markets, when we look at bond markets, we're looking at rising interest rate environment, something that we haven't had for a long period of time. The 10-year Treasury rose 30% in just a 2-week time period, 1.88 to 2.45, after it bottoming at about 1.4% in July. Barclays government was down. Again, interest rates go up, bonds go down. Barclays government was down 3.72 in the fourth quarter. Corporate and emerging markets had a positive year, +4 and plus 12.8 respectively. They held up much better. But high yields were probably the best. And again, we have a large exposure to high yields, which we're very, very happy to have and show that that's a total return of 17% was fabulous. Looking ahead on the bond market, we think that there's a new era dawning where we've seen 30 years of a secular decline of interest rates where bonds could go up. Now we're seeing the market flatten out over a period of 3 years, and now interest rates starting to rise. Will that create new challenges in the bond market as well as currency markets as it already has? And really what to watch for is on that tightrope, and do we raise interest rates too high or too low, and what kind of profits are we going to get from the risk we take in bonds versus equities. So equities may play a little bit bigger role in the asset allocation strategy going forward. When we look at stock markets, the stock market was really pretty flat in the fourth quarter until the election, and the 37 days after the election, you can see the market appreciated 9%. The overall market, Russell 3000, the Dow in and of itself, because of financials, was up 8% to year end. 4% of that came in the first 6 days after the election. The post-election rally kind of fueled the market in the fourth quarter. The Russell 1000 was up 3.8, 2000 small caps 8.8. Value outperformed growth on the Russell 3000. Financials had a huge benefit throughout the year, 21% or 0.1%. Most of that coming again in late in the year, excuse me. And then energy, another positive, 27.9 year to date. Some sectors that also improved were industrials and telecom and materials. Healthcare, consumer staples, and real estate, as you can see, had negative scenarios, which were kind of the opposite of what happened last year. So looking forward, we have the question, are we on borrowed times, or is the market getting ahead of itself a little bit? And I think that could be an answer to yes, based on maybe some false hope that may not transpire. But if the Trump card can be played and he plays it effectively, there's some tax reduction there that could be pretty effective, I believe. Global markets are a different animal. When we look at the global markets here, we have a monetary easing policy in Europe for most of this last year, which kind of drove their profits in markets. But then because of some negative talk on the trade in the fourth quarter, we saw global stocks decline pretty significantly in that 3 to 10% range. And again, bring it to a level that we believe to be of even better valuations, so relative to the US. So those are, again, negatives can be positives, and that's one of our positives that we bring to the table. Real quick summary on where we're at. Investors really, again, as you know, we've talked about uncertainty, the scenario, the Fed raising interest rates, a lot of the other scenarios that we talked about. That's going to be more of the same in 2017, but probably more important, because I've never in my 27 years of managing money, individual asset management on a fee only, have I had such an uncertain time period where we could go left and right in one day because of the volatility of our leadership here in the United States as we speak. So again, could go either way. So diversification is really going to be the key, and with the dynamic marketplace that we have, we want to mitigate risk. A lot of people are asking, is diversification dead? Large cap stocks have been top three of the last 5 years. One of the top three. Emerging markets have been down and been in the bottom 3 of the last 5 years out of the major 10 indices. Developed emerging markets, bottom 3 in the last 5 years, 3 of the last 5 years. So when we look at this picture and you see the green and the positives that you see on the green, and then you see the commodities versus REITs, but even more than that, you see the emerging markets, those light blues, and then you see the developed market internationals, the grays, in the bottom half or bottom 3. We give kind of a contrarian viewpoint. We'd love to see those move up to the top, which usually does have a chance to do. Just for fun, is kind of with the last page of our newsletter, we want to give you a recommendation. And Lotus Leaf, a restaurant in Eden Prairie. Chris from our office loves the great Thai food that they present. Adam from our office just made a sheet pan dinner of rosemary chicken. That's Adam's favorite, newest favorite. And then quote of the quarter from John Shevlin in our office is, out of clutter, find simplicity. From discord, you find harmony. In the middle of difficulty lies opportunity. I believe that there's a lot of difficult times going out there right now, a lot of uncertainty, but again, that presents opportunities. Thank you very much for your continued trust in the All-Star Financial team. Remember, our referral program reduces your fee. We were able to grow substantially by just referrals this last year, and we appreciate that. And last but not least, this is our team. Give us a call if there's anything that we can do for you, for those clients or potential clients that are looking at this. We'd love to answer any questions you have. As one of the leading fee-only advisors in Minnesota, we'd love to be able to earn your business. Have a great day, and we'll talk to you soon.